And would you invest in Tesla?
No.
Investors are actively buying shares of Tesla, turning it into the world's largest car manufacturer in terms of market capitalization. But why is the legendary Warren Buffett in no hurry to add Musk's brainchild to his portfolio? He has 3 good reasons for this. And the first reason is that Oracle of Omaha has always preferred to stay away from unpredictable investments.
It's not a business where we find it fascinating to be in. We like our dealership operation. But I don't think I can tell you what the auto industry will look 5 or 10 years from now. I do think that you will see a change in the vehicles, but you won't see anybody that owns the market because they changed the vehicle.
Tesla, with its high capital costs and inherent risks, is one of the companies whose future is very difficult to foresee.
Well, the electric vehicle is coming big time, and that's a very interesting development. At the moment, it's imposing huge capital costs and huge risks, and I don't like huge capital costs and huge risks.
The prospects for the industry itself also remain vague for the time being.
In 2030, when I'll be 100, I would say that I'd be surprised if more than a third of those would be electric. Well,
we're not going to quit driving cars, and the American public has a love affair with them. And I think I know where Apple's going to be in 5 or 10 years, and I don't know where the car companies are going to be in 5 or 10 years.
The second reason is that Buffett's investment philosophy is centered around the concept of return on invested capital. Tesla's value and earnings ratio seems too high to fit into this philosophy. Today it stands over 40. The smaller it gets, the more profit an investor can receive from the invested capital. For example, Apple Berkshire Hathaway started investing in a whole thing when this ratio was only at 5.
being the low-cost producer, for example, is a terribly important moat. And something like Geico, technology has really not brought down the cost that much. And I think our position, there are a couple of companies that have costs as low as ours, but among big companies, we are a low-cost producer, and that is not bad when you're selling an essential item.
Buffett often cites his investment in See's Candy as an example. The bottom line is that a company that requires minimal capital to operate but generates significant profits will invariably deliver excellent returns to its shareholders in the long run. Before we reveal the final reason, give this video a like and subscribe to the channel if you want to show your appreciation for our work. Thank you. Finally, and perhaps most importantly, Berkshire Hathaway only invests in companies that have a consistent record of profitability, valid for 5 years or more. Tesla has recently moved into profitable territory, thus it doesn't meet the criteria set by Buffett and his team. Increasing and maintaining profitability at a high level in the automotive industry will not be easy.
Amazon can raise the price of Prime, 20%, and you can't do that unless you've built something within that image of the Amazon Prime that's based on reality that you're going to get a lot for your money and you're going to want to use it. And then you can raise prices $20. But if you're selling, if you're selling some commodity product, you can't do that.
Tesla is sure to remain on the Berkshire radar though. Still, Musk's company needs to address all three issues in order to be an attractive investment opportunity for Buffett. Share your attitude towards Tesla in the comments below. Press the like button, subscribe, and check out our other videos.